what we noticed going back 150 years is that whenever commodity prices become really cheap relative to financial assets, and today they're as cheap as they've ever been, but whenever they get really cheap, it corresponds to a big shift in the global monetary system. The first was in 1929, and that spelled the end of the classical gold standard that had really been in place since Napoleon. The second was in 1968, which is when Johnson, not Nixon, Johnson took the US dollar legally off gold. Nixon shut the gold window in 71 because the US ran out of gold to be able to be redeemed by foreign governments. And then in 1999, following the Asian currency crisis, you had all of the emerging markets peg their currency at below market rates to spur their exports and accumulate treasuries as a result of that. Massive shifts in the global monetary system. We don't really have a name for the last one yet, but history, looking back, obviously will. It resulted in, capital flows in the high single-digit trillions, low double-digit trillions flowing from the West to the East in the form of treasuries. It allowed for things like the housing crisis and what have you, and it was incredibly impactful. And so the reason I bring that up is that every time commodities get cheap, we have a shift in the monetary system. And as I like to put it, we're in the right zip code for that to happen now. Here in the US, the zip code is like a postal code. We're in the right neighborhood. I can't tell you exactly when it's going to happen. I certainly can't tell you what it will precisely look like. But I think, if history is a guide, when real assets get this cheap, we tend to have a rethink and a little bit of a shift in how we conduct monetary policy. And I think we're going to have it this time here too. And not just monetary policy, but the whole global monetary system. And in that world, I think it looks more and more clear like gold will retain some sort of a monetary function. Not saying we're going back to a gold standard, because I don't think that we are, but I do think that gold will be used to potentially balance different trade imbalances around the world, whereas today it's US dollars and treasuries that fulfill that role.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Adam Rozencwajg. So Adam is the managing partner at Goehring Rozencwajg Associates. So Adam, thanks so much for coming on the podcast today.
Oh, nice to be back, Anthony. Nice to talk to you again.
Yeah, and I look forward to the conversation. Last time we talked extensively about energy markets and what's happening there. And I think, it's been... That was the end of last year, and since then we've had lots of further geopolitical risks and other factors coming onto play. So just from your perspective, what is your current overview of energy markets at the moment?
So we're remain incredibly bullish on global energy markets, both oil and natural gas. But I think natural gas in particular is probably the market that is the least well understood today, North American natural gas in particular. And I think that really has the opportunity and likelihood, frankly, to move sharply higher in the second half of this year. So that's where I think people are really getting things wrong and missing the mark.
Yeah, it surprised me because I guess from a natural gas perspective, especially US, prices have come so low. I know there's lots of trapped gas around as well. Lots of flaring. There's almost too much. There's too much of it at the moment. So I guess from your perspective, or there was too much of it. So why are you bullish on it in the US?
So first of all, we love to get involved in markets where everyone is wildly bearish and everyone thinks that there's no hope in sight. That's where we thrive, and we really kind of roll up our sleeves to understand what could be changing in those markets. And the reason we like them so much is, not because we're just gluttons for punishment, but because that's where you find the value. And so there's value really laden across the resource sector. It's still, energy's less than 4% of the S&P, considering the long-term average is closer to 14%. I would say that's pretty undervalued. Commodities relative to financial assets are as low as they've ever been, maybe with the exception of last year and the year before. But this cycle, we're still cheaper than we've ever been at any point in history over the last 150 years. So you have value throughout, but natural gas is still that area of the market where people really start to lose their lunch and they start to get a little bit queasy thinking about it. And that's where we like to try to find opportunities and try to look for areas where things are going to change. And we see a lot changing in the global gas market markets, the U.S. gas markets, both on the demand and on the supply side, that lead us very, very optimistic for the rest of this year and into next year and beyond. And we can talk all about what that is. But the reason that everyone's so bearish on gas today is really twofold. The first reason is inventories are high. So inventories are about 600 BCF above their seasonal averages. You have to seasonally adjust everything with gas inventories because we build all these inventories through the summer months and then we draw them down in the winter when heating demand kicks in. And so inventories today sit, comfortably above the seasonal average for this time of year. And that's what's led everyone to be really, really bearish. But you have to understand why they are high. And of course, like the adage goes, you have to think about where they're going, not necessarily where they are today. So they're high because we've had 2 back-to-back very mild winters in the Northern Hemisphere, both in the United States and Canada and in Europe. And that's curtailed quite a bit of heating demand. And so that's why inventories have built. That explains 100% of the build over the last couple of years. And, it happened. It's there. I think when you predict demand, you have to predict normal weather. I think it is foolish to predict, the mildest winter on record, but that's in fact what we got. So inventories are high. Because of that, prices are low. But of course, the most important question is, where do they go from here? And we see a very clear trajectory for inventories to normalize and actually get to dangerously low levels sometime in 2025. And it's a combination of 2 things. It's almost the perfect storm. It's demand and supply. On the demand side of things, we're bringing on a huge amount of new LNG at the end of this year and into the beginning of next year. And in fact, that then continues through 2025 and into 2026. And actually, if you look at those numbers, we're talking about the largest 3-year increase in US LNG export capacity that we've ever seen. So it dwarfs what came online over the last couple of years. The US used to be a net importer of natural gas. It then turned to be a net exporter and is now the world's largest net exporter of LNG, liquefied natural gas. And for all of that growth, we're actually going to have the sharpest ramp up that commences really any day now. They're commissioning the first of the new facilities as we speak, and that continues on for the next couple of years. So demand, I think, is set to grow very, very sharply. And it's occurring at a time when supply is now starting to roll over. And, your comment a moment ago, I think, is very consistent with what a lot of people think when they think of the US natural gas market, which is that it's in this persistent and abundant oversupply situation. There's almost too much gas, or in some cases, people think there's almost limitless gas. But that's not the case anymore. That was the case over the last decade. We grew U.S. shale production from like nothing to 90 BCF a day. Divide that by 6 and you get the oil equivalent. You're talking about 13 million barrels of oil equivalent that came online from the shales. So I don't blame anybody for feeling as though U.S. gas supply is limitless. But immense is not the same thing as infinite. And there's been warning signs that we've been flagging for a couple of years now that perhaps the shale gas revolution is beginning to at least enter middle life. And now I think is actually beginning to decline entirely. And while that might sound shocking and unconventional, I would, ask you, what do you think U.S. gas supply has done over the last several months? And it turns out that, most people, I'm going to preempt your answer, most people don't get this right, but actually dry gas supply in the United States peaked in December of 2023 and is now about a BCF a day below that. That's the most recent data for February. We're expecting March data to come out tomorrow or the next day here. The early indications for the shales for March, April, May, and June are that will actually decline by another BCF a day. And since that's been the only source of growth in the United States over the last 15 years, conventional production declines and declines and declines. You would actually find yourself in a situation where we think the total US dry gas supply will be down by about 2.5 BCF a day between December and June of this year. That's the sharpest decline in US supply outside of COVID that we've ever seen since the shales have been brought on. So we're not running into gas. In fact, gas supply has turned negative just as all this new LNG demand is about to start up. And to me, that's the perfect storm. And, if you go back, we could look at the absolute gas price, and the absolute gas price on a dollar per MCF basis bottomed in April at $1.50, basically tied with the all-time low price made in 2020. And there's been a couple instances over the last decade where gas has broken the $2 mark. However, in most of those cases, it's been because the whole energy complex has sold off, right? So in 2020, when gas made its low, oil was negative. Similarly, in 2016, gas broke $2, but oil traded down to 27. Today, gas is really cheap, but the rest of the energy complex is quite tight, including seaborne LNG prices. So it's really a U.S. phenomenon. A single barrel of oil for delivery in the United States fetched the equivalent of 53 MCF of gas. That's crazy. The energy equivalent price is 6 to 1. One barrel has the same energy equivalent as 6 MCF of gas. We got to 53. That's nearly a 90% discount on the energy equivalent price of natural gas. We've only ever had that one time before, and that was back in 2012. Again, at the end of a very mild winter, actually just as mild as this winter was, 5% milder than normal. We got a 53 to 1 oil to gas ratio. But just think how different the US gas market is today compared to 2012. Back in 2012, we were about to bring on 40 BCF of new shale gas over the next 8 years. And we had no LNG export terminals. The first one didn't open up till 2017. So we were running into new supply, and we had no outlet in order to evacuate that gas from the United States. Today, we're now the world's largest exporter. We have the biggest tranche of new LNG export demand about to turn on imminently. And instead of running into 30 Bs or 40 Bs of new supply, we're actually declining. And you don't have to take my word for it. The Energy Information Agency, the EIA, they put out what's known as the short-term energy outlook. And in the last 4 months, they have gone from expecting, pretty material supply growth in the US in 2024 to now predicting that supply will be down full year 24 over full year 23 by 1%. That might not sound like a lot, but that means that we'll lose 7 BCF a day from where we are right now in order to hit those numbers. That's dramatic, just at the time when we're bringing on 7 BCF a day of new LNG over the next 18 months. So this is not 2012. The market is acting like it is. The stocks are very depressed. They're trading at, 1 times their net asset value on proved reserves at $3 gas. That's really cheap. And I think investors need to start taking notice.
Thanks for running us through. That's really interesting. So, what impact does this have, I guess, on global, LNG prices? Because, there does need to be does it just arbitrage it out, or there does need to be, I think it's $6 or, maybe about that of costs to actually export it sometimes around the world. So does it just mean that TTF and other LNG prices go up?
Well, look, you could make the case that actually, in fact, might depress global LNG prices because we're adding a huge amount of new supply in the US. I don't really agree with that. I think that in the 17 years that I've been studying the LNG market, analysts have always expected new supply to depress price, and it hasn't happened because demand has always grown to meet the new supply. So I would consider on a global basis, demand for LNG, there's latent demand, there's repressed demand demand for gas on a global basis would be higher if people could source that gas. And to put that in perspective, in 2017, when I started looking at the LNG markets, 2007, when I started looking at the LNG markets, Analysts were worried at the time that Qatar ramp up would depress the global LNG prices. And what people usually do is they compare the global LNG prices to the global oil price. And that's how they determine whether the LNG market is in surplus or deficit. Similar to what I said before, 6-1 in the US versus 53-1 is what we got. To me, that means they're dislocated. And so everyone thought that Qatar was going to dislocate the LNG market and it would break its oil-linked parity. So not only did Qatar come online, but the US went from being the world's largest importer of LNG to the world's largest exporter of LNG. No one had that in their model. I mean, imagine taking out your single biggest demand line and replacing it with the world's largest supply line and tell me that you wouldn't have a surplus. But sure enough, we didn't. And global LNG prices remain high and they remain in line with oil parities. So all of that extra gas has been absorbed. And I think that is going to continue. So I think that bringing on this new supply from the US probably has little impact on global LNG prices. It probably increases the global LNG demand picture, right, to fill that new supply. But I think ultimately prices there should remain fairly stable. Where it will have the biggest impact will be in the United States itself, where gas, having been at $1.50, could easily get up to $6, $8, even $10. You could envision a situation where you could still have that price and still have it make sense, depending on the global LNG price, of course, to export, into a strong seasonal period, let's say. So I think that the biggest beneficiary and the biggest shock to the market will be the US domestic price, and the gas producers who have the good, high quality remaining acreage stand to benefit the most from that.
Yeah, it's interesting. And as you say, lots of people talking about gluts in the past, and I think people are talking about that in 2026 with, more trains coming online in Qatar, more in North America and other parts of the world. So it sounds like you don't agree with that take. And as you said, latent demand will come online from China and India or other parts and sort of swallow it up.
That's right. And I think the big thing that analysts get wrong, and look, don't get me wrong, you could have a period, a real wet period in China where hydro production goes up and all of a sudden they stop buying incremental cargoes and prices are depressed for a period. You could have a really mild weather period that impacts demand in a number of jurisdictions. So the gas market is notoriously volatile, and I think everyone needs to be aware of that. However, I think fundamentally the reason why all of this demand can be absorbed is that most analysts don't look at the gas demand on a global basis properly. What I've often seen most people do is they try to look at either they extrapolate growth trends presently, or they start to look for relationships between GDP and gas demand. And what that fails to take into account is, I think, pretty profound and pretty important. That is, GDP growth impacts total energy demand. However, gas as a percent of the total energy mix is also impacted by GDP, meaning that the same unit of GDP has a different impact on gas demand depending on how rich a country is. As countries get richer, they want to move more and more away from coal and towards natural gas. Natural gas is a pretty incredible fuel. It's not carbon free. However, it's very efficient. It's the most efficient form of electricity that we have outside of nuclear power, which we can talk about as well, because we're very bullish and remain very bullish on uranium and nuclear power going forward. However, on the hydrocarbon side of things, it's very efficient. It's more efficient than coal. It's certainly, an order of magnitude more efficient than renewables. And it has half the CO2 of coal. So people want to move towards gas wherever they can. And more importantly than the CO2 emissions, natural gas is a clean fuel. So there's less particulate matter in the air. And that has a huge impact on, the air quality in places like Beijing, Shanghai, and certainly in tier 2 and tier 3 cities throughout China and India. And as a country gets richer, they want to have a nicer environment. They don't want to breathe polluted air. I actually disagree with that statement, even though I just said it. I think that when a country's poor, it also would like to have a cleaner environment, but it can't afford to. And so it's only when there's some surplus capital in the system, when there's some additional GDP above the subsistence level, that we start to see these countries move more and more towards natural gas. And that's what everyone's gotten wrong. If there's one thing that they've gotten wrong, it's that everyone has held their gas mix shift, or their gas mix as a total percent of total energy, as relatively fixed, and they have not been able to appreciate the increase in gas as the market share of gas in the energy mix. And because of that, you have a huge sucking sound for natural gas on a global basis, and that's going to continue.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening. Yeah, it's a great point. So if we go to oil markets, what are your current thoughts on I guess what we're going to see? And I know there's been lots of talk about peak oil, which is seems to be a trend that keeps coming up every 5 years, whereas the IEA and other organizations predicted, and then they push it back. So what are your thoughts on that?
Well, look, the peak oil people get a little bit of a bad rap. Conventional production peaked. Everyone thought it would peak in 2005 on a global basis, and it did. King Hubbert first predicted that in 1971 U.S. conventional production would peak, and it did. So there's a lot of lessons to be learned from the textbooks of the peak oil nuts, as they're kind of branded these days. However, I think that they're really, really, really important fundamental points there. It's basically the idea that once a hydrocarbon basin reaches 50% produced, it begins to peak, plateau, and roll over. And that's been shown time and time and time again. Now, the issue with the shales is that they were really, really big. And so their total recoverable reserves were huge, some of the biggest fields discovered in the history of oil. And because of that, production was able to ramp up very, very quickly and sharply. And it seemed for a time as though that was almost like an infinite new source of supply. And the peak oil people were all made to feel very, very foolish. And indeed, peak oil now often refers to peak oil demand as opposed to peak oil supply. But all the lessons learned in conventional hydrocarbon studies, I think, are equally applicable to the shale oil basins. And when you look at them, what you quickly notice is that they are all approaching halfway produced in terms of their total recoverable reserves. And so if history is to be a guide, we've been arguing for the last couple of years that growth in all of these basins would begin to dramatically slow and then roll over. And that's exactly what's happened. So just like the shale gas fields, shale oil fields all peaked in November of last year and have now fallen consistently over the last 5 months. And the International Energy Agency, the IEA, which puts together the global supply demand models for oil, they still have the U.S. growing sharply this year. And I just don't think that happens. So demand has been very, very strong. The main source of non-OPEC oil supply growth has now ground to a halt decisively. And I don't think that's going to change. And it's simple. When you look at the best areas in these shale plays, whether it's the Permian, certainly the Eagle Ford. The Eagle Ford hasn't grown; it's declined now for the last 5 years. Why we don't study that and say, well, what do we learn from that and apply it to the other basins? I have no idea. But when you look at these basins and the best areas in them, they're completely drilled out. They are drilled to very high densities, and it's going to be very difficult to get a new generation of incremental production growth from those areas. So without that, you end up drilling lower and lower quality rock. Your productivity per well degrades. We're seeing that. The average well per 1,000 lateral feet is producing less oil today than it was last quarter, the quarter before, and the quarter before that. This is not the sign of a healthy, growing field. This is the sign of a field that's starting to suffer from depletion. And no one seems to really get that and have it in their models and in their numbers. And when you look back, a year ago, let's say, the U.S. government did something kind of funny in the middle part of last summer. They changed the way they report their oil numbers. And when you make the adjustment that they made, you begin to see that a lot of the growth that people were talking about last year was actually not real. It was just the fact that you weren't comparing apples to oranges. And the big tip off there is that the US in the second half of last year apparently staged this massive recovery of several 100,000 barrels a day in terms of production growth, but the shales didn't grow. So where's it coming from? It's not coming from anywhere. There's no other field out there that we're not counting or that we're not looking at. Conventional didn't all of a sudden arrest a 50-year decline and start to hook back up materially. Instead, it's just, production is faltering. And when you try to look at the company data, when you look at the shale data, when you look at the total data, they don't all line up together. So the U.S., the number one growth driver of non-OPEC oil supply for the last 15 years, is now beginning to slow. And historically, when that happens, prices move a lot higher. There's been two periods in the past where that's happened. The first was in 71, where the U.S. was the main driver of non-OPEC oil supply. When it started to peak and roll over, prices rose dramatically. OPEC gained market share, pricing power. They waged two different, oil wars against the West. The first was after the U.S. helped Israel, and then the second was after the Iranian Revolution. So, the 70s were a period where oil prices rose tenfold, and it's because non-OPEC oil supply began to slow. The second time that happened was in the early 2000s, when the 80s and the 90s saw the North Sea and the Gulf of Mexico increase production materially, and so we had some really good growth years in the non-OPEC world. Prices were fairly stagnant, and then in the early part of last decade, those started to slow and roll over also. And again, the main source of non-OPEC oil supply growth turned off, and oil went from, $11 a barrel to 145. So what does it do this time? I don't know, but we're seeing non-OPEC oil supply growth slow dramatically because the the shales are slowing, and that's going to drive prices higher.
Yeah, it's interesting. It does seem like there's quite a lot of growth, I guess, in South America. So Guyana is a large one. Brazil, Argentina is sort of where we're seeing things. And then there's hope for sort of other parts of West Africa. And I don't know, maybe is sort of on there as well, on top of the Middle East. But do you think they won't be able to replace, I guess, the US oil that's going offline? Or how do you see that?
Well, they certainly won't be able to replace the growth. When you look, the U.S. regularly exceeded 1 million barrels a day a year of growth, driven entirely by the shales. You're not going to be able to get that on a sustained global basis. And I think that there's a little bit of a danger in focusing on major new projects, because there are always major new projects that come online. And then, of course, there is the base decline in the non-OPEC world. And so what you really have to look at is how much is coming on from new projects and whether that will be enough to offset the declines. So yes, Guyana is coming online. Although it's not without its problems, it does look to be a very promising play. And I think that that will help to arrest some of the base declines in the rest of the world. But when you have the biggest source of growth driver turn off, that's going to be really material. And like, let's not forget, right, over the last decade, you had a huge subsalt ramp up in Brazil as well, and Canada grew quite nicely too. So you'll get pockets of growth, but will they be enough to offset declines in the rest of the non-OPEC world? I think is a much tougher question. And I think the answer is no. So when you turn off the shales, there's no way that that doesn't impact the world, and doesn't impact the non-OPEC world. Doesn't mean that new projects won't come online. They just won't be enough. But, you know, we're very bullish on the offshore space, and that's where we actually have probably about 10% of our investments are in offshore drilling companies, because I do think we're on the verge of seeing a new offshore renaissance. And look, you know, I don't think that we're going to go back to living in caves and loincloths. The industry will do what it needs to do, but it'll require higher prices. It'll require investment, which in turn will require the stocks to do well to incentivize that investor capital. And historically, when you have a big growth driver turn off, prices move higher.
Yeah, that's a great point. And I think, yeah, as you said, offshore, deep water, you know, a lot of these, I guess, barrels, which are, you know, probably cheaper to produce, as well as lower emissions potentially than shale and not requiring to constantly have to, you know, dig new wells. That seems to be where a lot of these companies are looking at. So it'll be interesting to see how that goes down. So in terms of, you mentioned nuclear and uranium. So uranium's had a massive run up, you know, over the past year or so. So are you still bullish, I guess, on the commodity and the industry in general?
Yeah, we are. You know, we like to look for value, and we like to look where, like we said before, the idea turns people's stomach. And certainly, nuclear power and uranium did that back in 2019 when we made the bulk of our investments. Uranium was $19 a pound, and Cameco could be had for $9 a share. Today, it's, you know, above 50. So it is not an unknown trade anymore. Lots of people are talking about it. I think ultimately, when we try to compute a long-term mid-cycle price for a commodity, and that's what helps inform our long-term valuation decisions, you know, 125 bucks uranium, it's at $100, give or take today. You know, would that balance the market? Yeah, given enough time and enough capital, you could bring on enough new mine capacity at $125 uranium to probably meet depletion and new demand growth. However, there's a lead time to those mines. We've starved the industry for capital for quite some time. And so I think uranium will overshoot the mark to the upside. But we're not in the same environment we were a few years ago. Uranium's not $19 a pound with the incentive price to bring on new supply at 125. You know, the cash costs of existing mines back then was $25 a pound. So you were below the cash cost of the big incumbents. It's not that market anymore. It's the middle innings. I think we'll overshoot. And so I think there's still, you know, some more juice in the lemon, but, you know, it is not an undiscovered trade anymore. So it'll probably be a little bit more volatile here. You know, the hedge funds got involved in the third and fourth quarter of last year, and we saw some of that money come back out in the first quarter of this year, and the stocks were weak. Now they're doing nicely again. So, you know, it's just a different phase of the bull market. The bull market is by no means over. It will be over when new production comes online. When that happens is anyone's guess, but it's not going to be before 2028.
Okay, that makes sense. So, how can you talk about how you're positioned? Is it obviously overweight? Sounds like gas. You said you're bullish on sort of deep water. You know, how else are you positioned? If you can talk about it.
Sure. We have core positions now, you know, not huge changes from where we've been. Core positions in uranium, natural gas, and oil. And I put the offshore drillers in that natural gas and oil bucket. All right. I'm not going to break out E&P and drillers. You can go on our public disclosures and see how that's broken down. But, you know, all those together probably make up 65, 70% of the portfolio. And then the rest is in copper and gold. And gold's been the stocks in both cases. And gold has been an area that we've been adding to in recent months. We are gold bulls. We're not gold bugs. I don't think that gold at every point in the market cycle is the right decision. And I don't think that gold is the panacea to all of life's ills. I don't think we're going to go back on a global gold standard. I don't think that if we did that, we would all of a sudden have, accountability from governments and lacks of deficit spending and stuff like that. In fact, there's some really interesting books that go back and look, in the Middle Ages, they figure that gold and silver coin debasement by shaving the edges resulted in 2 to 3% inflation per year by devaluing the money by 2 to 3%. Not materially different than what we have seen in the complete fiat system. So gold, I think, needs to be valued against other financial assets. And there's times where it's really cheap and represents a good investment, times where it's expensive and represents a bad investment. And certainly on those metrics, gold has been and remains extremely cheap. However, there's been something that's been keeping us from entering the gold market until somewhat recently. And that has been that real rates have been rising and are high. And the Western investor and speculator is accustomed to selling all of their gold investments in the face of rising real rates. And that's what they've been doing, since the beginning part of last year, beginning part of 2022. Western speculators have sold and shed like 800 tons of physical metal, and they've been dumping shares of gold stocks like crazy. You just have to look at the shares outstanding of the GDX or the GDXJ to see that there's been net outflows over the last couple of years. However, what changed at the end of last year is the central banks have now stepped in, or the middle part of last year. And last year, central banks bought 1,000 tons of gold, more than offsetting all of the Western speculative shedding. This year, they're continuing to buy at record paces, and they're buying now more than at any time since gold was money under Bretton Woods. And so what that's done is it's put a bid under the gold price, and it's resulted in gold making a new all-time high because, if the central banks buy 1,000 tons and the Western speculators sell 750 tons, then you need to come up with 250 tons from somewhere, and you need to use price to bid that away from largely Indian and Chinese physical buyers. So that's what they've been doing, and prices are making a new all-time high. People then ask, well, why are the gold stocks sucking wind so badly? And, you want to be cautious whenever you think an explanation makes too much sense, because you're probably getting something wrong. But I think it's as simple as this. Central banks are buying gold bars, but they're not buying gold shares. The Western speculators dumping both. And so the gold equity market is basically no bid, and prices are super depressed and represent really, really good attractive value. So that's how we're playing it now. The question, of course, is whether the central banks will continue to buy gold at the same pace as they're buying today. And I think the answer is that until I'm shown otherwise, I'm going to go with yes. And the reason is not just a random reason, and it's not just for the sake of maintaining the trend, but what we noticed going back 150 years is that whenever commodity prices become really cheap relative to financial assets, and today they're as cheap as they've ever been, but whenever they get really cheap, it corresponds to a big shift in the global monetary system. The first was in 1929, and that spelled the end of the classical gold standard that had really been in place since Napoleon. The second was in 1968, which is when Johnson, not Nixon, Johnson took the US dollar legally off gold. Nixon shut the gold window in 71 because the US ran out of gold to be able to be redeemed by foreign governments. And then in 1999, following the Asian currency crisis, you had all of the emerging markets peg their currency at below market rates to spur their exports and accumulate treasuries as a result of that. Massive shifts in the global monetary system. We don't really have a name for the last one yet, but history, looking back, obviously will. It resulted in, capital flows in the high single digit trillions, low double digit trillions flowing from the West to the East in the form of treasuries. It allowed for things like the housing crisis and what have you. And it was incredibly impactful. And so the reason I bring that up is that every time commodities get cheap, we have a shift in the monetary system. And as I like to put it, we're in the right zip code for that to happen now. Here in the US, the zip code is, like a postal code. We're in the right neighborhood. I can't tell you exactly when it's going to happen. I certainly can't tell you what it will precisely look like. But I think, if history is a guide, when real assets get this cheap, we tend to have a rethink and a little bit of a shift in how we conduct monetary policy. And I think we're going to have it this time here too. And not just monetary policy, but the whole global monetary system. And in that world, I think it looks more and more clear like gold will retain some sort of a monetary function. Not saying we're going back to a gold standard, because I don't think that we are, but I do think that gold will be used to potentially balance different trade imbalances around the world. Whereas today it's US dollars and treasuries that fulfill that role.
Yeah, it's really interesting. So do you see silver having a similar sort of, I know it's probably the more speculative asset, it's used in sort of some industrial purposes. Do you see that having a similar trend, or is that just completely different?
No, so silver, every gold, precious metal bull, I don't want to say gold bug, feels that for precious metals to have a strong sustained rally, silver has to outperform. And strictly speaking, that's not really true. If you go back and you look historically, and my partner Lee's done a lot of really interesting work on this, but if you go back and look historically, typically what happens is that at the outset of the precious metal rally, silver actually underperforms, and it can underperform rather materially. And then what happens is it stages this massive recovery where it surges in price and makes up all of the underperformance relative to gold. And so when it's all said and done, perhaps silver outperforms, sometimes it doesn't, but it definitely sticks in everyone's mind because it has this crazy fast catch-up rally. And actually, that's a good sign to get out of the precious metals markets after silver does stage that catch-up rally, because typically prices re-rate and kind of normalize and trade sideways or even down. And that was true in 2021 when silver, the Reddit crowd got involved in silver. They bulled it up, and you had this massive catch-up rally of silver relative to gold, and then gold did absolutely nothing for the next couple of years. And I think that will happen again. So for the time being, I'd prefer to have my money in gold-related investments. You can have some silver in there too. It might be dead money for a little while until it stages that catch-up rally. I'd favor gold at this point in the cycle.
Perfect, makes sense. And the copper trade, is that sort of to do with, I guess, supply demand dynamics that we're currently experiencing, similar to, I guess, uranium potentially?
Yeah, copper's in a real tough spot because we just haven't explored and developed enough new mine supply to offset declines in demand. Everyone thought demand would be weak last year because of Chinese property sector sluggishness. Didn't show up in any of the numbers. China imported a lot of copper, demanded a lot of copper. It's not showing up in stockpiles, which are quite low. We have new demand from places like Indonesia, certainly India, which is way behind in its copper development. So the demand story, I think, remains very strong and intact for the foreseeable future. And on the supply side, we just haven't sanctioned enough new mines. So we always knew that there would be this big gaping hole in supply relative to demand starting about now. And that's been made a lot worse with various supply disruptions. The two big notable ones are in Panama, where the government shut down Cobre Panama. It was like 5% of their GDP, a couple 100,000 tons a year of copper, big mine. And then the other is in Chile, where they're having major depletion problems in Chile, and that's starting to actually come through in the numbers now in a real material way. So we have a very, very tight physical copper market. Global smelters are having a really hard go of it. So the smelters, they buy copper concentrates from the mines around the world, and then they refine it into pure refined copper for, other end use demand. And what they're seeing now is just a lack of copper concentrate. And so actually what they call TCRCs, or treatment charges, refining charges, have actually turned negative in some cases, which kind of defies belief, but they're hovering right near zero, meaning if you're a smelter, you're willing to basically buy the copper for a negative margin by the time you run it through in order to, help amortize some of your fixed costs. So, crazy but true. The world's super tight for copper, and that's why prices are moving higher, and the stocks will follow suit and have followed suit. Medium term, though, I think there's some really interesting technology coming down the pike, led by Robert Friedland and his team at iPulse, based in France. And what they're working on from a mining technology perspective is some of the most important new tools to come out in the mining industry he would probably say ever. I might agree with him, but certainly in the last 50 years or so, both in terms of technologies to explore for copper deposits, which are showing really strong results now, as well as new technologies to crush, grind, and process rock using 90% less energy. If you can do that, then all of a sudden some really low-grade sulfide material goes in the money, and we'll find the ability to bring on new supply that way, if nothing else. So there's some really interesting technologies being worked on. The compared to the energy industry, the mining industry is like back in the Stone Age. You could you could thaw out a 19th century exploration geologist, and the only thing that he wouldn't recognize in a modern exploration geologist team might be the GPS. He's used to using a compass and a map. Other than that, it's the same strategies. You go around, you chip off rock samples that outcrop at surface, and you hope that they have some anomalies that could then zero in towards a deposit. What they're talking about doing now is fundamentally different and would allow underground imaging up to thousands of meters of depth, far below the economic threshold to mine. So all of a sudden, all this new prospective land that has been blind now begins to open up, deeper than 200-300 feet, which is traditionally where exploration geologists using the current technologies can't really see below that. So there's a huge amount of new stuff being worked on. The copper industry has a history of new technologies disrupting it. Obviously, the oil and gas industry does too with shale. In copper, it's known as SXEW, as oxide copper in the 1980s and 1990s. Really ramped up. It went from nothing to 20% of global copper production because we unlocked a new technology that made it economic to mine those deposits. We knew where they were, and then we went after them. Copper spent 15 years in a bear market because of it. So could something like that happen again towards the end of the decade? I think it's totally possible, but there's a bull market between now and then.
Yeah, perfect. Adam, thanks so much for your time today. I really appreciate it. We've done a whirlwind tour of the whole commodity markets, and I think we covered it very well. So, my last question is, what is one message you'd like people to take away from our conversation?
Look, I think we're early innings in this whole resource bull market. Most of the resource sectors have outperformed now for the last 3 years. But when you look at them on a long-term chart, weightings in the indices or commodity prices to financial assets, whatever you want to look at, it's still like a blip off the bottom. It's the case of something having fallen 90% and then doubled. It's still down 80%. The math doesn't quite work the same way, as when you have these huge drawdowns. No money is being invested. No capital is coming into the space. You look at CapEx budgets and they're basically up by inflation, nothing else. So, we have a lot of legs to go on this. It'll be choppy. The commodity markets are always choppy. But I think we have a good, strong bull run out ahead of us. And I think people should take advantage.
Perfect. Great message. So thanks again. So if anyone wanted to find out more about your work and what you do, where would the best places for that be?
Well, just our website, Goehring Rozencwajg. Like I always joke, Google's smart enough that even if you get it half right or a third right, it'll point you in the right direction. It's such a particular set of two names. We put all of our quarterly letters, podcasts, letters, videos, the whole bit. We were having an investor day in October of this year. I'd recommend anyone who's interested to get in touch about either visiting in person if they're in the New York area or listening in remotely. So that'll be more details to come on that.
Perfect. I'll put that in the description below, but thanks again for your time.
Thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.